In this video, we're going to look at part 3, calculating after-tax net salvage value, and then the NPV to see if we're going to accept or reject this project. The information you see over here on the left in yellow is copied from part 2 of problem 12-9, so it should look familiar. Anything in green is what we're adding. To calculate after-tax net salvage value, stick to your 4 steps. I need to calculate book value first. Book value is costs minus accumulated depreciation. I originally paid $120,500 for this asset, and 93% has been depreciated. 33% in year 1, 45% in year 2, and 15% in year 3. If I add up all of that, that's 93% of $120,500, which is $112,065. That leaves me with a book value of $8,435. The second thing I need to do is determine whether or not I have a gain or loss. I'm able to sell this machine on the market for $65,000 with a book value of $8,435. That's a gain of $56,565. Step 3 is determine the tax on the gain. The gain is $56,565. My tax rate is 35%. So I'm going to have to pay $19,798 in taxes. And finally, my after-tax net salvage value. Someone wrote me a check for $65,000. I wrote the government a check for $19,798. The difference in those two, $45,202, is what plugs in down here as after-tax net salvage value. In addition, I've got to add back my net operating working capital. We're going to assume that when we sell this machine, we're going to sell the spare parts inventory along with it. That's $5,500. So I add up these 3 items, and that totals my third cash flow, $85,628, which I have placed on the timeline up here. Now I'm ready to calculate NPV. Here are my keystrokes. Minus $126,000 from my initial investment outlay, $42,518 for my year 1 cash flow, $47,579 for my year 2 cash flow, and $85,628 for my year 3 cash flow. My weighted average cost of capital is 12 according to the problem. If I plug this into my calculator, my NPV is $10,841, which is positive, so I should accept this project.